What are the safe havens, in your opinion? Anyone? I mean, the obvious one is, you know,
I'll
yellow.
go obvious. The yellow metal, yellow and silver metals.
Okay.
I think that's really the if everything is in trouble,
Yeah.
that'll be the place to go. You could also go in the cryptos if you wish to, pick your favorite one. I think they're here to stay with us. I think it'd be interesting to see. We've talked about some super cycles. When we talk about are we going to a commodity super cycle where we're going to start valuing things again? Well, the first thing everyone's going to value is the thing that culturally we've used for hundreds of thousands of years, probably, is the shiny metal. So what do you guys think? That's where you have to be.
Oh, well, that's why the aliens came here and interbred with some species here on Earth because they needed someone to mine the gold for them. You ever hear that one?
Thanks,
Huh?
thanks, L. Ron.
Yeah, so gold. Okay, so let's talk gold. Gold got hammered this week. It certainly wasn't safe haven. So I mean, it's not just the if what we do as traders. The art of it is the when, isn't it? Okay, so maybe this is a great level to buy gold. Maybe 1700 is a great level to buy gold. But that's a trade. You're right. At any price, to have possession of precious metals and something with intrinsic value, years from now, who knows where these metals are going to be. But, we're used to timing things. And I think this break in the metals is going to set up a great buying opportunity for, you know, $19 silver, 1750 gold, something like that. Yeah.
It's a much different type of investment when you're doing things like that. We're not talking about when you're talking about a transition from, from fiat to metal again, which
Yeah.
now the economy the way it exists right now could not function with metal as the primary currency. There's just not enough of it. It's that simple. We can't divide it up. We can't move it. We can't do any of that. So how is how is that transition to things from fiat because of what the central banks are doing in this drunken orgy of $1 trillion means nothing. Um, where are we going to go, and how is it going to happen? That's the interesting thing. The volatility Rich talks about, it could be everywhere, in the major pairs. What do you guys?
I think in the short term, I wouldn't discount 2 and 10 year bonds. And in terms of safe havens, we're seeing a big run towards safe havens in terms of 30-year bonds, especially US Treasuries and UK gilts. Um, as the as the prices rise and yields fall, we're seeing big investment into 10 and 30 year to try and get away from the risk because they are effectively so low risk. And when the Fed's basically printing the money to pay you your yield, there's not really much to worry about, really. Um, but at the same time, if we look at something more fluid and tradable, the Swiss franc has been unbelievably stable for the last couple of months. And I think we're seeing massive volume flow through the Swiss franc at short notice, especially between the euro and the Swissy, but also that we're seeing it go into the Swiss franc for a few hours whilst something's not behaving like the US dollar. And then as soon as the dollar recovers to a solid position, it flows back out again. And we've seen that repeatedly, especially on the baskets for the Swiss franc, that the money flows through the Swiss but never actually stays there very long. And they seem to be using that as the more volatile the Swiss franc is for me, the higher the risk in market right now. Sorry, Doug, go.
I'd say they're using it as a parking mechanism.
Yeah.
Are you seeing that at all? I saw that the pound complex was fairly well bid the last week. Is it? Do you see that type of action also within the pound?
To a lesser extent, yes, but I think Brexit is effectively forcing the pound to be one of the things that volume is flowing away from rather than to, especially as we approach the deadline next month. And it looks less and less and less likely every day that passes that we're going to get some sort of Brexit deal. I mean, I was hoping for the president to be chosen, no matter who it was, Brexit to be sorted, and a COVID vaccine to be implemented so that as of about May next year, I can just set my traders to work and make some money. I mean, these markets are a lot more difficult than they were, say, 2, 3, 4 years ago, where you could shovel it off the table because there were trends. And we're not seeing those trends establish themselves. And when we are seeing them, they then tend to lead to long periods of consolidation. One thing I would say on that is I think it's interesting that dollar weakness now seems to mean not only yen strength, because that's normal, but very significant yen strength. But the moment the dollar turns that corner, just that tiny little beginning of the corner on anything, the yen experiences a significantly size sell off, and we're back to the dollar. And so we've got this money moving nearly on a daily basis between the yen and the dollar at great speed for whatever is the best return. And I feel very much that organizations like JP Morgan Chase have obviously got a dollar basket price in their head. And as soon as it goes below that, we see capital flow away from the dollar, and then the dollar hits rock bottom for as it stands at the moment, and then it all flows back again. And we just see this seesaw process with the dollar and the yen, which, although neither is a safe haven, they seem to be acting as safe havens for each other in terms of intraday trading.
Rich, I'd like to ask you a little bit about emerging markets. I think that just because of where you're located and decided to go, that you probably have a pretty good feel for global markets. And it's the emerging markets that are really benefiting from the dollar weakness. You could pull up a lot of their different charts, and even, dare I say it, we even had a turn in the Turkish lira, which is anything but a safe haven, right, Andrew? And even that's starting to, gain against the dollar. The ruble's acting good, and I've been told, really the economic fundamentals of Russia compared to debt to GDP, I think they're only at about 10% debt to GDP compared to the U.S. at 130 or so. Wondering if you see other regions of the globe as being more opportunistic if people are going to start shifting away from U.S. markets because of dollar weakness.
Well, you get two issues there, because a lot of those emerging markets, and I think we've discussed this previously with Doug using Africa as an example, their economies are effectively dollarized at this point. And the Chinese have made great inroads, and there are some bilateral things where they're pricing in yuan, and certainly with the Belt and Road Initiative, they've made a lot of investment, but it's still going to be a while before a lot of the truly emerging markets break off from the dependence on the dollar for their economy and pricing things. But if we look at sort of more mature EM, and particularly Southeast Asia and places that appear to have coronavirus under control, and maybe working out arrangements directly with China, or benefiting from sort of the ASEAN bloc, that's a place to look and might feel safer. I think the other thing is just stepping back to get off the EM. If you're looking within, S&P 500 companies, sort of dividend-paying consumer brands are still a pretty solid bet if you're looking forward, and you're looking at it from an income place. You get in and take that dividend and see where you are in 2 or 3 years, because things will normalize. Coca-Cola spiked up post-election on the vaccine news and things like that. And always a fan of alcohol stocks like Diageo. It seems to be an essential good.
It is.
Either for celebrating or isolating. So, that's one of the things. But it's interesting on the EM, and then if you get even further into what you'd think of as being frontier markets, which are difficult to invest unless there's a handful of ETFs where people can go through. That's really a longer term play, even if we step back from what's right now, just based on the demographics of places like Japan, Europe, and to a lesser extent, the US and Canada. Those countries are all younger, and we are seeing a shift, but that's a multi-year generational move. But, people should be getting away from this just home country bias and only sort of investing what they know and taking a look around the world, because a lot of the really good stuff is going to come from areas that we're not thinking about at this point because we're biased towards either European or North American time zone for investment.
Yeah, so Andrew, I was under the impression a weaker dollar because a lot of these economies had to denominate their debt in dollars, and that a strong dollar was making it more difficult for them to service debt. So if the dollar comes off 10-20%, that's jet fuel for their economies, isn't it? Can't hear you. You're muted.
Yes, definitely. A weaker dollar would do a lot of good for emerging markets and developing nations. However, we start to hit some real problems that, because the reason debt is denominated in US dollars for most of these countries, and as Rich said quite rightly so, apart from a small part of Africa that's dependent on pegging against what is effectively a version of the Swiss franc, um, there's a limitation to the upside for them, because on the flip side of that, you have gold prices, diamond prices, oil prices, where as the dollar weakens off, we should see counter correlated pricing kick in to reassess that market.
Nominal gains, you mean?
Yeah, yeah.
Okay.
So
won't that cause inflation in their home country though, especially for the lower classes? And this really affects them when we weaken the dollar that way. They're going to get their bread and milk becomes 20-30% more, and it's a significant part of their when they spend in Africa. I think it's somewhere 80% of their time is just getting this essentials still.
Yeah.
80. It's depends what you judge as essentials, because actually, if you look at the US, UK, and Europe, you'll find that most countries within those areas, especially within Europe, you'll find it's probably not much more than 65 to 70% of wages go on what would be considered Maslow's hierarchy. So 80% is probably on the low side, Doug. So yeah, a shift of 2% inflation, an increase of 2% inflation domestically in emerging markets would be enough to seriously destabilize their localized currency and force dollars, like say Zimbabwe and the problems that happened there over the last few years. They've now completely dollar denominated, and if there was an increase in oil prices, that would have a significant impact, especially in countries that don't have their own oil. And I think the other thing is a weaker dollar means higher oil prices. That's also going to be an issue for the Japanese as well, because the Japanese buy all their oil in, they shut down all their nuclear power plants, they're heavily reliant on natural gas and fuel oil. If they see sudden spikes in oil prices just because of counter correlated activity with the US dollar, then we are looking at a real problem for Japan, because although they'll see domestic inflation for the first time in decades, it won't be real consumer inflation. It will just be cost push inflation. And there's nothing that will then, the goods made in Japan will then have to get more and more expensive as they're shipped as well. And we can't forget how reliant Australia, New Zealand, China, Europe is on the provision of Japanese electronics. that's going to be a real issue. So a significant devaluation in the dollar could be dangerous. But to come back to what Dale was saying about the idea that debt's denominated, that is why we saw the Fed print so heavily over the last few months to ensure there was enough capital in the market so that we could assure volume flow, because they were concerned that the dollar would actually start to rise too aggressively and start to collapse the smaller economies, and to some extent have a massive impact on Japan. Dollar is the what did Rich say the other day? I keep stealing this phrase from you, Rich, but it's really good.
The best dirty shirt in a bag of dirty laundry.
It's like the best house in a bad neighborhood, but dirty shirt works too.
Good, I'm wearing one.
Yeah.
All right, so I think it's interesting, this inflation discussion, because I interview a lot of people. I talk to a lot of traders across the globe, and there is a theme by guys like Peter Bookvar, who's on CNBC. They're all looking for an increase in inflation. So, Doug, I want to ask you this. Also, Jerome Powell, the Fed, talked about that they would tolerate higher inflation, that it's okay. In fact, they welcome it. Is it because they welcome it, or now they have cover for when it comes, that this is what they were planning for anyway?
I think it's a combination, and I think it's mostly they're. I've spoken to Andrew about this a lot. They're boxed. They can do nothing else except what they're doing and more of it. They have no choice. So any excuse that they can find to be looser, they will. Notice they didn't change the inflation target to make it tighter and make it, is it relevant to people's lives? They both made it on an average, so you didn't have to worry about, it wasn't just a 2% target. It's an average over time, and what the heck that means. They can define it any way they want. Okay, we're going to take the average now over the last 10 years, even though we had a 15% spike last month, and we're not going to care. I mean, where does it average? Where does it even work? I don't even. What they proposed was just an excuse to keep the press printing. That was it. We're going to use the type of measures that are going to show lower inflation, not higher inflation. So I don't think there's anything different than that. I wish I could say there was, and they're going to keep doing it. They're going to until it becomes pushing the string, and we know they've gotten a lower return with over each dollar over the last 5 years. I think it's pretty obvious if we look at the data.
Just one thing, a thought that came to my head, and I want your comment on it, Andrew and Rich, is that, the U.S. mainly acts not pre-crisis, but during or late. And, what I'm seeing technically as far as the market being kind of ripe for a good correction, maybe that's what both the Fed and Congress needs, is a 15% sell-off for them to have a reason to go ahead and even feel the pressure that they better do something, rather than when the S&Ps are making new contract all-time highs. What do you think? Well, Andrew, Rich?
It might give cover or impetus. I think one of the things to, if we think about what's gone on since we had the economic shock brought on by the coronavirus, is that politicians will always say that, Wall Street's doing fine, Main Street's really feeling it. This has probably been one of those times where that's true, but if we look at it, it's not exactly Main Street that's feeling it. It's some parts of Main Street, right? We have a good section of most developed economies where people are doing, really just fine. Things haven't changed that much. If you can work remotely, if you're in a knowledge-based job, but then there's a lot of people who don't fit into the segment that hasn't been affected, and they've been affected tremendously. So the distribution of the effects here, there was the early thing was, the coronavirus doesn't discriminate. But we know that it does discriminate against lower income and people who are in manual or non-office based employment, because that's what gets shut down to a greater extent.
Yeah.
So, if we had a correction or market capitulation, whatever we want to call it, that might create greater impetus. But there should be an awareness that there's real economic problems, and as Doug was saying, things are changing, and we are going to have a generation or two of people, certainly in the developed countries, if you're within certain groups, who are going to be scarred from this, and they're going to be affected disproportionately. And we're not really having a conversation about how that's addressed, and what things should look like going forward. We're just back on, well, we're going to take and print money, and we'll give away money, which for a while is great. But if we destroy the productive capacity of a large segment of population, the plan, I don't think it can be, maybe I'm wrong on this, but it can't be just to keep giving people money for an infinite period of time. That somehow doesn't feel sustainable to me. I'll welcome anyone else's thought on that, but just seems like we should have a plan to get a plan, at least.
I think one thing I'd say there is that I'll come back to your we need a plan to get a plan, Rich. But to start with, I think the first thing I'd have to say is, in relation to a 20-30% fall in the major indices, triggering the Fed to take new action, my concern is, what new action does the Fed take? Because the Bank of England's made it very clear that negative interest rates by large financial countries like the UK and the US could be incredibly detrimental to the system. Very, very detrimental to the system. Because then you get runaway inflationary pressures within the key financial markets, and which would be a shift to a higher risk bracket that I know the Bank of England isn't happy with. Andy Haldane, the chief economist of Bank of England, he has been very, very clear that it is not a sensible option.
Yeah, so it's probably a fiscal, right, Andrew? Yeah. And I do remember, I have a memory of TARP not passing the first time in 08, and then the market got clobbered one more time, and they all came back and passed it. So I'm just, because our government right now is dysfunctional, that maybe it's going to take pressure from constituencies whose 401ks are under pressure to call their senators and congressmen and say, do something.
The problem with that, though, is we start to see equity markets top out, indices top out, they start to fall. We see 5, 10, we see the circuit breakers kick in. Over the course of a week, we lose, say, 10 to 15%. The next week we open up, we're down 5% on the open, the circuit breakers kick in again. By the end of that week, we're then down 30 odd percent. By then the politicians are starting to think we should do something. Every day past around 14 days of a sustained fall, so 2 working weeks, you are looking at losing 2% a day, there or thereabouts, in free fall until there is action. At which point fiscal stimulus wouldn't be quick enough to fix it. The Fed would have to intervene, and they'd either have to go to negative rates. Like, basically, what I am describing is exactly what happened to the Turkish lira over the last few weeks.
Yeah. They're just going to buy assets. Come on, guys.
Is there anything left?
Let's be real. There's nothing left to do. Okay, there is no. They have one choice. It will be if your scenario happens, there is only one choice at that moment. The Fed will step in and actually buy ETFs and securities. Just like how much of the Japanese market is owned by the Bank of Japan?
Yeah, it's a good example.
Yeah, it's about 30%, and the Japanese government owns another 20 to 30% as well, because that gets into Hayakian zombie economies and zombie companies, which is for a different time. But yes.
Right. So we're talking 60%.
Yeah.
Okay. Total. Right now, what does the Fed own of the U.S. market? We know they own some of it in the bond market on their balance sheet itself. Still looks small, relatively speaking to the size of the market. But, how big could they go? I mean, they have an infinite balance sheet, guys.
So we're literally then talking about the market topping out at some point, we don't know when, a significant fall over the course of 2 weeks, say, then direct intervention from the Federal Reserve, and then the market literally whipsawing back the other way. Because if the Fed comes out and says nobody's allowed to go bankrupt, we're buying, everybody's buying, because the Fed will just print until it's done. I mean, you only have to look at Hertz.
Right.
Maybe that's what the megaphone formation is saying. Really, if you guys have seen that chart pattern, right? Where you go up, you make new highs, and then you make new lows, and then you make higher highs, and you make lower lows. It looks like this, it's a megaphone. Maybe that's what the market's saying, is it's the Fed could save it, and then it can't save it, then it could save it. It's a very disorderly technical pattern. It's one of the most difficult to trade.
Well, we're sat waiting for a trigger, aren't we, Dale? Basically, in your scenario, we're not just basically sat waiting for that event that causes that trigger, and until then, we're jumping both ways.
Yeah, we're trading. We're just taking signals and going with the best risk reward we have in the market at the time. And right now, I just think that risk reward that people over the next month or so might be thinking more about return of capital instead of return on capital. And I hope I've cheered everyone up with my views here in the market. But why don't we wrap it with this one line? Okay, what is going to happen with the presidency in the U.S.?
I still think Trump concedes by Thanksgiving unless something turns up that's a smoking gun.
Okay. Rich?
I think it extends out with a little less volume and less of the echo chamber. I think people are fatigued by where's the evidence, where's it going? So I think we're getting a little less of this. But the one thing Donald Trump has shown us, throughout his public life and certainly as president, is if you think there's nothing he can do to surprise you, wake up the next morning and see what's happened.
Okay. What do you think a surprise could be? Even though no one could really guess, but you have an idea, I think.
Well, I don't know. I mean, there could be something, arcane that comes through or pressure on one of those states, but, with the recent sort of call on Arizona by everyone, it's looking less and less likely that there's something substantial that can happen.
Okay. Andrew, from across the pond, what do you think?
Trump doesn't concede, and effectively Congress has to ratify and declare Biden the president-elect, because I notice he's using the logo already, but he hasn't yet been ratified. And I don't think Trump concedes before that happens, so I don't think fiscal stimulus until next year, and I think that might be the trigger for what you were talking about.
What a great discussion, especially when it ends with someone agreeing with me. My favorite way to end a podcast. So, guys, thank you so much. Really enjoying getting everyone's views every Friday. It's our mission at TradeGateHub to build up and edify investors and traders and bring ideas to the table that they may not be considering, so that we're adding value to what they're trying to accomplish in a very difficult endeavor. And to all our viewers, I hope we've done it. We leave it all on the court every week for you guys. So thank you very much, Andrew, Doug, Rich. Have a great weekend, guys.
You too. Thanks, Dale.
All right.
Enjoy.
All right. Thank God for football. The real football, Andrew.
Unless you're a Jets fan.
Yeah.
Or Giants this year.
Yeah.
We're suffering too.
All right, guys. Have a good weekend. I'll see you Monday.